A startup is a very risky endeavor. I just want to remind everyone, and most fail, meaning they return less than the invested capital and often zero. So if you take outside money like we all do, we have a fiduciary responsibility to care for that money and to use our best efforts to get a return for that outside money. So we have to care about M&A because the sale of the company is the main way to achieve a return for investors and a return for you.
Welcome to another episode of Startup Health Now. We've got a very exciting fireside chat today with two of my favorite people, Samer Hamadeh, who is the co-founder and CEO of Zeel, startup health company, and James Marciano, who is the founder of Tuck Advisors, also a startup health investor and longtime serial entrepreneur and investor himself. It's going to really be an exciting show today. We're going to talk on the topic of M&A and really dig into all the ins and outs and things that entrepreneurs and health transformers need to think about from the very, very early stages of building their business all the way through potential opportunities. So welcome, Samer and James. How are you guys doing?
Excellent. Thank you, Unity.
To kind of frame things, I mentioned you guys are both serial entrepreneurs yourself. You're both investors. You're both advisors and sit on boards. You've really seen so many different things. We'd love to learn a little bit more about your backgrounds just to set the context, and then we'll dig into kind of the core of the conversation. James, why don't we start with you, because you built some companies and now you with Tuck Advisors really work with companies to help them scale and work on M&A opportunities. I'd love to hear more about your background, James, and Tuck Advisors, just to kick things off.
Sure. Thanks, Unity. As Unity said, we've been friends for a long, long time. I started back in 1995 building one of the first social networks on the web called thesquare.com, and then started another company called Refer It back in 1997, which was the first director of affiliate programs for e-commerce companies. And then the third company called Return Path, which was just acquired last year. And so started those three companies, raised angel investment and raised Series A actually for the Square 48 hours before the market crashed in New York. So we were the last company in New York to get funded. It was really an amazing time. And through that process had some offers for our companies and really weren't really ready for them. And we called them UFOs, unsolicited flying offers. And we wound up hiring an investment bank in San Francisco, and frankly, they didn't do a very good job. And so after I we wound up selling those three companies, and then I became an angel investor for about a dozen years. And we moved out of New York to raise our family here in Bucks County, Pennsylvania. And I was really anxious to get back to building something myself. And again, my own experience had been pretty poor hiring investment bankers for M&A. And so 5 years ago, we decided to start Tuck Advisors to help other entrepreneurs make sure they maximize their exit.
And what types of companies do you work with? Do you work at companies at all stages, or a particular stage or sector?
Yeah, so I'm a startup guy, and I really love working with other entrepreneurs. So we work in what's called the lower middle market. So enterprise value, call it 5 to 100 million, and we we focus specifically on health tech, and we also do some ed tech. And we love working with younger companies that are, a year or two away from exit, because it's just an opportunity for us to get to know them better and to help them along. Sometimes there's opportunities to do buy-side work, even for small companies. And we're now also doing capital raises. So we do, sell side, buy side, and capital raises.
All right. So we'll dig into some of that in a second. But Samer, want to also refresh everyone on who you are and some of your background. You've got such a diverse background as a longtime serial entrepreneur, member of the startup health transformer ecosystem, investor yourself, board member yourself of different organizations. Share a little bit more about you, Samer.
Yeah, thanks, Unity. First, James, you beat me to the punch on starting a tech company. I started my first one in December 1996, Vault.com. And with respect to M&A, I've got two direct experiences. So I was right on the front line selling Vault.com in 2007. to PE. It was between PE and a strategic, Dun & Bradstreet. And then I was right on the front line selling campusfood.com to Grubhub back in 2011 as interim CEO and a board member. And I've been part of lots of sales along the way as as a strategic angel investor, obviously, and advise a lot of founders on M&A. So I've got a lot of views on M&A, which we'll be happy to share today. It'll be a fun conversation. In terms of investing, yeah, I've got a fund at Lightspeed Venture Partners, a scout fund. I'm a venture partner and advisor at Alpaca Ventures here in New York City. And I love startup health. I think I was in the first cohort, right, Unity? So
very beginning.
Yeah, very, very beginning. And Zeel was always an unusual company, which isn't necessarily the conversation for today, where we're delivering massage therapy to the home. And COVID, which kicked our butt, was the conversation of the fireside chat a few months ago, how we're sort of pivoting and expanding into in-home healthcare with nurses and physical therapy and some other services. Anyway, today's about M&A, so excited to dive into the topic and also answer people's questions.
The world's changed, obviously. We're a year into the pandemic. I think it's a very confusing time for growing companies. In one sense, you're hearing about these multi-billion-dollar transactions, companies like Livongo and Teladoc merge, almost a $19 billion merger. We're seeing even companies in the startup health portfolio, big mergers and acquisitions like Doctor.com and Press Ganey, just announced Gene by Gene and MyDNA, Cloudbreak and UpHealth doing a SPAC. But there's also a lot of companies that are going through transition, figuring out what's next. How do you guys both view the kind of the moment we're in, and what's your perspective? Are you optimistic? Are you think there's certain things that the broader kind of community should really be thinking about strategically as they're setting themselves up for going into 2021 and managing their business? Would love to hear from both of you on this.
Yeah, I'll jump in. I mean, there's certainly going to be a lot of winners and losers. So as I said, we represent mostly healthcare companies, health tech, and we had a client this past year that sold to hospitals, and they the CEO and the board decided they wanted to go out to market. And as you can imagine, if you sell to hospitals and you're trying to sell your company to a company that also sells to hospitals, right, which is a pretty typical kind of M&A scenario where you're finding a buyer that has the same customers that you do. Everybody was just in panic mode, right? Like hospitals are losing tens of millions of dollars, a day, and there was no appetite for trying to acquire another asset. There was just people were just trying to stabilize their own companies. I think and there's a difference there between PE companies and PE firms and strategics. I think the PE guys kind of rolled with it a little bit better. If you're selling a larger asset to a PE firm, maybe had a little bit more luck last year. Strategics, again, were just in survival mode. But then we also have, two healthcare companies we're representing now. One in it's going to be a $10 million Series B. It looks like it's going to be more like 20 or 30 million that does telehealth. So, huge winner in COVID. And then another company we've been working with for 3 years, behavioral healthcare company. We helped them acquire found and helped them acquire 2 digital assets last year. And now we'll be taking them out to market just because, again, obviously things are super hot for behavioral health. So certainly winners and losers, but no doubt that COVID's accelerated lots of things in healthcare. And it's definitely an exciting time.
And I would add, Unity, that obviously I'm not a macroeconomist, but with interest rates really low, obviously, and the government spending a ton of money right now, people want to invest in the next thing that could make them more money. And right now that's stocks, private or public. And so with respect to health tech, which is probably the hottest sector right now, it feels like there's just so much money out there. And I think it's going to be out there for the next 18 to 24 months, at least from the experts I talk to. Not just because of the money too, there's also just a ton of innovation. You always said, Unity, you and Steve, when you started Startup Health, that health is one of the last sectors that had not really gone through the technology revolution, through the revolution of software eats the world that Mark Andreessen always talked about. But it's now happening, and it's happening so fast because of COVID, and it's such an enormous sector.
So at Startup Health, we focus on long-term and collectively achieving health moonshots. So we're always really trying to get to the core of how we can help our companies scale, how they can make a greater impact. And let's just dig into this topic of M&A. I think it's a broad topic, obviously, and I think it means a lot of different things depending on when and why and how and the stage and all sorts of things. But let's just start digging into some of this, and really, I'd love to understand from both of your perspectives, when or why should founders even begin to start thinking about M&A, mergers and acquisitions opportunities, as a way to help them accelerate their business or really help them achieve their health moonshot?
I can start off, James. A startup is a very risky endeavor. I just want to remind everyone, and most fail, meaning they return less than the invested capital and often zero. So for the founder or founders, a return of just the invested capital often means the founder gets zero because the invested capital is invested with a liquidation preference. So if you take outside money like we all do, we have a fiduciary responsibility to care for that money and to use our best efforts to get a return for that outside money. Otherwise, don't take the money. So we have to care about M&A because the sale of the company is the main way to achieve a return for investors and a return for you as the founder. Obviously, the other ways are you can create a profitable dividend-paying company. That's actually what we did at Vault before we sold it. And that's a rare thing, I think, in the tech world. The other way is to create enough perceived value, right, that a future fund buys shares from early investors and you get some liquidity that way. And the third way is to go public, right, which is currently a pretty hot way for health tech companies. But that's why we have to care about M&A. That's what it's all about.
And I would just add to that, you should always be prepared, because if you get one of these UFOs against unsolicited flying offer, you have to be able to weigh that against what your other opportunities are. So if you're kind of caught flat-footed and you're not paying attention, and you don't have your books in order and other things, right, it's going to be hard to get a transaction done. And so, I think that's the other thing is, just be ready. And I once had a colleague of mine, I remember it was on the West Coast, and it was in my office at 55 Broad Street across from the New York Stock Exchange. It was Christmas Eve, 1998. And it was probably like 11 o'clock at night. We're both working. And he said, you should always know who you're going to sell your company to before you start it. And, maybe that's not entirely true, but I think there is some wisdom there. And I think it's important to remember, that half of all M&A transactions happen because of an existing strategic partnership. And so, and I think the primary reason for that is that as a sell-side advisor, the hardest thing for me to do is explain to somebody that's never heard of your company why they should care, right? What you do. Yeah. So if you're already in the mix, right, and you're working with people and you're in their stack or whatever, forming those relationships can be a really helpful way to get your, potentially, get an exit. But again, I think Unity, the key message is, kind of be prepared and be thinking about it and be open-minded.
You mentioned this concept of UFOs, which I'd love you to unpack a little and really explain what that is. Are you seeing more of them? And how, and then leading into how can companies or founders start to be prepared, as you say?
Yeah, we're all startup folks here, right? And so you have this constant push and pull between, hey, I want to build a product and I need to go raise money to build my product, right? And what I always say is, if you build something of value, the investors will find you. And the same is true of buyers. And so when a company gets a UFO, right, that's a signal to us at Tuck Advisors that they've built something of value, right? Because I like to say that good companies don't go unnoticed for long.
So how do you guys know when to take one of these unsolicited flying offers seriously? Time is so valuable to all founders, as everybody knows. You don't want to waste any time on just random things that come in. How do you start to decipher the signals that there's something worth investing time in? What are some lessons learned from both of you?
Well, I want to add to what James was saying. It does partially go back to being prepared, Unity. So, obviously, if you get a call from a brand name strategic or one of your partners or a PE shop that's well funded, you know that they're probably taking it seriously.
I call them UFOs because a lot of times they're just a hoax, right? And they come in, and we've had these experiences where, they drag the team into it. And it's not only time and energy, but also emotionally. Right? As a founder, you start to kind of get one foot out the door, and it's really hard to then re-engage if that UFO flies away. We typically get engaged when a company has one or two or more UFOs. We come in and we look at it, and most of the time, they've signed an NDA, but it's not really sufficient, right? There should be a carve out for a no poach clause for employees and for customers, and sometimes that's missing if it was sent over from the other side. So we always first look at those NDAs. But then you really try to put structure around the process, because again, you don't want to waste time. So by the time we've gotten to the conversation, often it's been a couple of weeks or months that they've been talking. So with one healthcare company, they've been talking to 2 UFOs for 6 months. We came in and we shut it all down, and we said, LOIs are due in 10 days, right? You guys have talked enough. And so we got those 2 LOIs in, and one was for 6.9 million, the other one was for 12 million. Client was really happy about the 12 million. We started marching down. They flew 14 of their people out to 3 different conference rooms at our client site. And 3 weeks before we were supposed to close, they got involved in a multi-$100 million acquisition in Europe. And they said, can you just wait for us, right? We need to do this other thing first. Can you wait for us? We'll be back in 6 months. At that point, I said, look, we've been completely transparent with you that if you slow this process down, we've built a book, we've built a buyer list, we're going to go out to market. So we went out to market, wound up getting 10 weeks later, we got an offer for 24 million. So, that's the idea of kind of making sure you put structure around the process, putting in time limits, and having a second best alternative, right? If we hadn't had that buyer list in that book, we might have stuck around for 6 months, but our client knew that we were ready to go and put some pressure on the deal. And it turned out very well.
James, could you share kind of a tale of 2 companies? One, when you first look at it, it's like, wow, this company's really prepared, and then one that isn't. And with the goal here of, we obviously want as many founders as possible to be thinking early, really from the early stages of building their business, on what they should be working towards to package their operation up in a way that really shows that they're on the one side of value versus the other.
Yeah, well, on the CFO topic, I've spent the morning interviewing 3 different CFOs for a client of ours where we're doing the Series B capital raise, because they don't have good financial controls in place. So I'm literally on the call with the lead investor interviewing the CFOs so that we can get this transaction across the finish line by February 15th. That's not the place you want to be, right? Like we're trying to find these numbers. The worst thing that can happen in an M&A transaction is the numbers start to shift and to change. And so I'd say, Samer hit the nail on the head with making sure that the books are in order, financials are in order. You understand how you book a contract. If you have a SaaS business, how do you recognize that, that ratably over time? All those things. It doesn't cost a ton, right, to do it the right way. And so you really want to be prepared there. And so this is just an example of a really great company doubling in revenue every year, right? They did 7 million last year in SaaS. They'll do 14 million this year. And they just don't have, founded by 2 engineers, super brilliant people, PhDs, but they didn't have the business people, in the company to be able to handle this type of stuff. And then we have another client where, they have the team, they have the controls, they outsource their taxes and that sort of thing, but all the books are there. Everything's neat. They've got everybody should have a dashboard, right? A management dashboard. You're looking at daily, weekly, or monthly, all the KPIs in place. Again, this doesn't necessarily have to cost a lot as a startup. There's plenty of resources online to figure it out, but those sorts of controls need to be put in place so that when you get a situation like Samer had, you can get through the due diligence. Otherwise, again, you're going to wind up wasting a lot of time and potentially the deal's going to break.
Yeah, and if you've ever seen one of these due diligence lists, there are many pages. There's like 50 to 100 items. The key ones are finance, which we've been talking about a ton here. Tech and product matter too. So I always sit down with our CTO, like, hey, we got to make sure all the passwords are buttoned up. All of the code is, written down and organized into a book. I think now people organize everything in GitHub, but in the old days it was a book, and you would map out all of the systems, because they're going to do tech due diligence as well. They're going to do legal due diligence. Again, like I said earlier, are all the contracts signed? Are the clauses in some of your contracts that say this contract will continue upon a change of control? You have no idea how many of those contracts you'll have where, like, hey, we get to decide if we will even assign this contract to your new owner. And that could be a significant contract. We think about those things every day when we're signing contracts now, because again, we're thinking ahead about what will eventually happen in a sale. We want to make sure to assign all our contracts, all of our IP. So anyway, there's a long list that you'd go through, and that would be the topic for a different session, obviously.
We have, as you know, there's pre-revenue companies, there's companies doing $20-30 million of revenue and everything in between. Would you both advise, to start focusing on these things like from the inception of your business?
I do inception now, because I've learned the hard way by losing deals when I was younger and less experienced. So we close our books every month, even pre-revenue. Just it's in the we get into the habit. We make sure every contract's signed. It does cost more money than you probably have initially, but it just softens that pain later that you'll experience if you don't have it together. So you have to do it.
Yeah. And the contracts one is a great point. Depending upon if you can transfer the contract to a new owner, that's oftentimes going to predict whether you're going to need to do a stock sale or an asset sale, right? So that stuff's going to tie into the legal. And I think it's important to also just kind of sequence some of these events. So, if you're responding to a UFO, if you're going out through an auction process, you're going to have a book, you're going to share information, make sure the NDA is signed if it's more information than you want to share publicly. And then you're gonna do a two-step dance. You can have an indication of interest where people are expressing a range of what they might pay based on the information And for those companies that are in your wheelhouse, right, they're in the range, you're going to invite them to management presentations. So, this Thursday, for example, I'm booked for 9 hours straight, three-hour management presentations for a client of ours. You want to do it together, so you're not giving one company an advantage over another. And then from there, you're going to ask for an LOI probably 2 weeks after that, a letter of intent. So there'll be about 2 weeks where you can ask questions back and forth. Once you get the letter of intent in, you're going to want to, it's going to be hopefully, apples to apples, but a lot of times it's apples to oranges. So you're going to try to get those, try to figure out what the best deal is for you. And then you're going to, kind of announce the winner. You're going to keep the other ones warm. And the important thing is, really the key to getting the deal closed is making sure that you have a good M&A lawyer, right? Because it's a different type of law. And you're going to have an LOI that really sets the roadmap. So that LOI wants to be very specific in terms of indemnity caps and, agreements for founders and, all those things. We have a list of, 15 or 17 things that we want bidders to respond to, because if you have that good roadmap, and maybe it costs you another week or two of legal fees, but once you have that roadmap, then you can move to phase 3 and you can get through those legal contracts much more quickly without a lot of discussion.
So James, you started getting into this, and I want to unpack it a little. You talked about two things. One, the process of M&A. So just really framing the steps from beginning to end and time. And you talked about the way you do it. I think that would be very helpful. And then 2, you talked about some of the partners that make sense for you as a founder to start surrounding yourselves with, whether it's a law firm, M&A lawyer, etc. Who are the types of partners that companies should start to build relationships with early, and what does that look like? And then we're going to dig into some of the questions that are coming in from the team. Sure.
Look, I would say there are very few M&A advisors that will work in the lower middle market. So if you have an enterprise value of 10, 15, 25, $50 million, which of course by the numbers, there's lots of those companies. It's just very hard to find somebody who's willing to focus on that. Most companies are set up to do much larger transactions, which is why I started Tech Advisors to help other entrepreneurs. So I would say if you can start to socialize your company with M&A advisors, just to let them know who you are, the more they can learn about your company, the better they can represent you in the future, right? So we love working with companies a year or two before exit. Definitely M&A lawyers. I'll tell you, I apologize in advance if there are any lawyers on this call, but I just hate lawyers. It drives me nuts.
I see one question that's come in Unity. Should we
jump
on it from Javier?
If you're there, Javier, if you could come off mute and frame your question, that'd be great. Otherwise, I'll just ask it.
Thanks so much. It's been awesome so far. Javier Evelyn out of Detroit. Just kind of getting a sense of, I had an advisor some time ago kind of saying, hey, you can get some insights when you kind of take a look into those 10K, 10Qs. And that seems like crystal ball. We know that there's a lot of like intangibles beyond that. So relationships, obviously, it's kind of like a lot of smoke and mirrors because there's other competitors looking at that as well. But from a starting perspective, to kind of have an initial list, what are your thoughts on the validity of kind of using that as a filter first and foremost, and then kind of maturing, obviously, when you get to the level where we start talking to you guys, if that makes sense?
Sure. No, it does, Javier. I mean, you're talking about public companies, obviously. There are no filings for private companies or PE funds for that matter. But I do as much research as I can when I get a UFO, especially if it's not someone we're currently partners with, to find out if it's a fishing expedition and they've got portfolio companies or a strategy inside that there's no way they're going to partner with us. They're just trying to learn a lot, which happens a lot, which is why, again, I know, James, you can't plug yourself. I'll plug you for you because you're one of those amazing, M&A advisors because you're a former entrepreneur, so you get it, and you charge very reasonable fees relative to what others do. But, a good advisor will, provide cover for you, so they can sort of keep some of those bad actors at bay. But yeah, the 10Ks and the 10Qs will give you some insight. They often won't really tell you about a skunkworks project. That's not something that has to be disclosed in public filings. So, look at those, talk to other partners. We've also done, a lot of people don't know about this. You ask your law firm to do a litigation search to see if there have been any lawsuits that startups have filed against this potential company. We've found some interesting ones sometimes that way when a UFO comes in. But yeah, the broader concept that you should do a lot of research to make sure you're talking to somebody truly legitimate.
Yeah, for public companies, I sometimes will listen into the calls with, they do the quarterly calls, and I've gotten, a lot of good information there. I remember one company we were selling, and the deal wasn't done yet, and we were on the call, and the CEO announced it to, all the people on the call that they were getting this deal done. And so at that point, we knew we had them over a barrel, and we were negotiating this one.
I just say, you got to use that to your advantage.
But we got them an extra $2 million because these guys were revealed it a couple of days before we were supposed to close. So knowledge is power.
Well, I think Javier's question also got me thinking about there's two perspectives here. There's our companies looking to be acquired by someone else, but there's also our companies who are looking to either merge or acquire other companies so that they can maybe scale more quickly. I'm wondering if you guys could both unpack that a little as thinking about M&A as a growth opportunity and really merging with other partners in a way that kind of sets you up for the future.
Yeah.
Well, I was going to say, I don't have a ton of experience, admittedly. The only one I have is I was serving as the interim CEO of campusfood.com. So obviously it's in the health tech space. It's a food delivery company. And at the time, there were a number of players, including Grubhub, and we were all pretty tiny. We were about 7 million of net revenue. So think about that for a moment, about 50, 60 million of gross revenue. And now this space is billions and billions of dollars. So very early, VCs weren't that interested in the space. I'll give a lot of credit to Bill Gurley, who came to our office and Grubhub's office and Seamless's office and asked us to do a three-way merger, which he would fund because he's like, I don't want to pick one of you guys and waste a bunch of time competing. I did that with Open Table back in the 90s and early 2000s, and it just burned so much cash. The founders couldn't get out of their own way because of all the egos to actually do the merger. He got very frustrated. It's about 6 months of dance. So finally, he just said, screw it, I'm just going to put money in Grubhub. To their credit, they had just launched the first iPhone app for mobile, for food delivery to the home. So because they did that, they tripled almost overnight. And so he put the money in, which then anointed them as the winner, which forced us and Seamless eventually to merge. So we did merge. It was primarily an all-cash buyout, but we also ended up investing in the merger round, if you will. So at any rate, it made a ton of sense. We're all competing against each other for consumers and for restaurants. And by doing the merger, as you know, Grubhub then went public. And so he took like this $300 million merger and turned it into, I think Grubhub's now a $12, $13 billion company. And I thought the space was over by then. I really did. And now you see DoorDash and Uber Eats and all these other players too, which is just fascinating to me. Because I'm like, I don't think the food delivery space is that big. But anyway, your broader point that doing a merger sometimes to really attack a market is to stop like cutting each other up to death makes a ton of sense.
Yeah, and I think, oftentimes smaller companies don't think about M&A. And the fact is you don't have to have a lot of cash, right? In Samer's example, you can do, if the principals can get out of their own way and figure out how to, proportionally rate their companies in a fair way, right? You can put them together and go attack the market. I think, one thing that we found, and this may seem a little counterintuitive, but I actually firmly believe that your salespeople might be the best ideas for M&A come from your salespeople, because they're the ones that are going to be on the front lines that know who else your customers are working with in terms of vendors. And again, because most M&A happens between companies where you have a shared customer, right? Like I'm selling, apples, you're selling oranges, we're selling to the same grocery store, right? Like maybe, and I have 1,000 grocery stores I'm selling to, and you have 50, right? I can put your oranges into my apple bag, and now we can sell them to 1,000 stores. That's how a lot of M&A happens. So if you're talking to your sales team and they're telling you about maybe what other vendors your customers are using, that might be an opportunity for you to gain insight into either a company that you might want to buy or merge with, or potentially could acquire you. I have a very quick story about that, Unity. I'll just tell you, my next door neighbor, I'm looking at his house to my left, works at a CRM company that does for wealth managers. And there was a company that they referred all their customers to for portfolio balancing. It's like this piece of the business that they didn't do. They didn't have a native way of doing it. Well, the other 4 companies in their space all referred their business to this same one company too. Well, one of those companies wound up buying that portfolio balancing companies. And now the other 4 companies are screwed because now they got to build it themselves. Why didn't my neighbor's CEO know about that from the sales team? The salespeople all knew about it because they were referring all their customers to them.
Well, I'll tell you why, James. I'm so glad you brought it up. So as a younger founder, in the 90s, I coveted the information around M&A. And I thought, erroneously, that if you as the CEO and founder hold on to it, like you'll get the deal done. No one else should know, because you also don't want them to get distracted by M&A or somehow to have it leak out. I've done a 180 on that view now, obviously, because I'm older and wiser. I let our executive teams know fairly early on, like if M&A is going to be the most likely outcome, because that is the most likely outcome for startups who actually end up returning money to investors, as we talked about before, then everybody needs to know about it, because ultimately I can't do it by myself. It's impossible. I've tried before. So the sales guy and the marketing chief and the CFO and others always know that we've got M&A opportunities floating around, and they're thinking about them. And we bring them up in meetings. And I'll talk about, like a few weeks ago, I said, hey, this public company, we actually have a partnership with them, and they're talking about it a little bit, with me. So I'm letting the whole team know, hey, it's early. Who knows if anything will happen? Here's probably why they want us. The CEO told me on the phone, and it's good for everybody then to have that, in their back pockets. So absolutely, James, for sure. The sales guy, the marketing chief, they all know what's going on. So when they hear something now, they're not afraid to bring it to me, right, and talk about it in our team meetings.
And then actually I want to dig into David Martin's question here. David, if you're there, if you could come off mute and ask your question.
Yeah, thank you. I wanted to know how long a technical diligence process should really take, and kind of how we should chronologically kind of put that out, because we would want to know, like, if we need a number on the table before we start showing what's under the hood.
Well, look, David, yeah, go ahead, James.
When you have a signed LOI that you're really happy with.
Okay.
Exactly. And I was going to say, James, in that LOI, you can also specify, like how much of the back end you'll show, and the confidentiality provisions around it, maybe how you stamp the documents, confidential. You could say if the deal breaks up, there's a data destruction clause. I mean, none of this stuff is foolproof, of course, because you're dealing with humans. You could also potentially do, I don't know how many times, James, you've done a breakup fee. I like to ask for breakup fees now because you had so many broken deals in the past, and like the buyer has no, I mean, aside from some legal and accounting and, getting some of their team members, involved, they don't really have that big of a cost fishing around. So the breakup fee can, get some of the bad actors, filtered through.
The other thing I've done is in a case where you have information, David, that is so so important, right? And if somebody saw it, you'd be in trouble. You can actually use a third party. So there's normally going to be a third party, technical due diligence team that's being used to vet your product. And what you might say is you might get the lawyers to agree that essentially that third party is going to have a report that just says, the code looks great, it's backed up, whatever it is, it checks the boxes, and it says it does what it says it's going to do, right? But it doesn't actually reveal the secret sauce. Another example of that, we had a situation where the buyer wanted to see our clients' contracts, but we didn't want them to know who our clients were in case the deal blew up, which it eventually did, by the way. So I essentially negotiated with the lawyers that their lawyer, the buyer's lawyers, would have access to those contracts, get the information they needed. Back to what Samer was mentioning, can you transfer the ownership of the contract, so that the lawyers were able to do their job, but the buyers never knew who the contracts were signed with. So that might be a way around it.
Yeah, I think it's a fair point, though, David. Paranoia is good. I like paranoia, so it's a good thing to be paranoid about.
Well, I just want to thank both of you for sharing your wisdom. I always love talking to people who have the expertise of being founders themselves, as well as investors, and really working with companies throughout the process. So thank you both for sharing your wisdom. This has been a lot of fun.
Startup Health invests in health transformers from around the world who are committed to achieving audacious health moonshots. If you want to learn how you can join this community of entrepreneurs, or if you want to connect with one of our 330 companies, go to startuphealth.com. Thanks for listening to Startup Health Now. We'll be back next week.